Welcome to the latest edition of The Bull, the Bear, and You as we navigate what is happening in the economy and we take a look at investing. I'm Stacy Smith, and I urge you to subscribe or say that you like this podcast on whatever platform you happen to use. We have had some big swings in the stock markets, and a lot of it has to do with AI and the return on investment. We'll dig a little deeper on the impact of AI on the markets and your portfolio, and there could be a warning sign from consumers. We'll discuss that. It's coming up in this edition of The Bull, the Bear, and You. And with me to talk about the economy and investing is my panel of financial advisors and experts, and they are Carrie Coghill of Coghill Investment Strategies. Next, we find Frank Rossetti. Frank has his own alternative investment company, HF Management Company. Also sitting at the adult table is Kim Forrest of Boca Capital Partners. And there's one more seat at the table, and that is occupied by Michael Godwin. And Michael is the Chief Investment Officer for Fracasso Financial Advisors. Thank you all for joining us. Wonderful day here in the Pittsburgh area. We have sunshine and warmer temperatures, and all that snow is starting to melt, but it's going to be a while before it happens. Well, if you're the kind of person who likes to see things take a slow and steady ride, last week was not the week for you. In 3 days, the major indices lost from 1 to 4.5% of their value, and then came Friday, and they gained back 2 to 2.5% of that value, with the Dow gaining more than 1,200 points in one day and bursting through and closing the day above 50,000 for the first time in its history. So, I am calling on my friends to use their intelligence, God-given or artificial, to explain just what happened. So anybody jump in there and tell me exactly. I know it has to do with AI, but why this big swing last week?
So can I lead it off, and just because I ride horses, and the market was what we would call a spicy mare last week, kind of doing her own thing and showing you who's in control. So spicy mare week is never a fun week for any shareholder, but here we are. And here is what the worry was, or at least what I believe it was, is there's a company called Anthropic that has a product called Claude that can write code. And what people are thinking is that any kind of corporate software that has ever been written is going to be rewritten for free, and Claude is the thing that's going to do it. And I think that really sent the market whirling, because we all use software, and there's a whole economy on this. And software stocks in particular sold down during that time. And by that I mean Microsoft and certainly Oracle, but Oracle's its own little universe. It has other issues there. But things like Salesforce, enterprise software that essentially runs the world. I think this is faulty reasoning. I am not going to go into it right now, maybe later, but Claude is interesting, but just normal people aren't going to rewrite these massive systems that have a lot of security and all kind of safeguards built into them using vibe coding. So there you go. I wanted to get my spicy mare comment in, and I'm going to toss it to the rest of the gang to see what you guys think.
Another reason along the same lines in terms of what happened last week, in particular with AI, has to do with these SaaS companies. Kim mentioned one, Salesforce, right? It's a subscription service, so you pay per user. So there's a lot of talk, particularly with those types of companies, and basically almost every technology company that we know has some sort of SaaS related revenue, and what AI might do to that particular revenue stream is huge. I will tell you, as now, what I mentioned this last time, that I had used ChatGPT to help me create a very fancy spreadsheet recently, and it worked beautifully. But my little formulas are very different than writing massive software. But it is something that we need to pay attention to in terms of how these types of applications really may be creating a paradigm shift when it comes to how things are done. We have to remember, Remember the Xerox machine. Remember how we used to have like calculators, Texas Instrument, our HP 12Cs. There are things and there are industries that will be shaken up. But as we've talked about previously, as with any disruption in an industry, it usually creates new industries. So we can't just look at the negative impact of new industries being created. We have to look at the opportunities that exist with it.
That's
Michael, you were the first to hold up your calculator. You still have one.
still use it. Yeah, I mean, this is going down, but I still got my calculator here. My brain doesn't work as well as yeah. Anyway, Carrie's 100% correct, I think, in this point because you don't really think about the jobs that are going to be created because you don't know what those are going to be yet. You can't be. None of us here have that crystal ball that can see what's going to be created because of AI. I really do think that the more I use it, the more I read about it, it is going to be somewhat transformative. And I think a lot of companies that are in existence today are and could be in trouble. I mean, Kim's right. As of now, these big software companies aren't going to go away, but this AI is only going to continue to improve upon, only going to continue to get better, I think. I think the code is going to continue to improve immensely, and what the average person can do, average being, I'm below average, but I'll be able to code something if I want to really help with a lot of my day-to-day activities. So you're going to get to a point where, a lot of certain jobs might become displaced. A lot of companies might be non-existent, but nobody ever really thinks about what's going to be created because of this on the other side. And that's really kind of hard to do right now, but this isn't going to be a scenario where I think thousands and thousands of people are going to be unemployed. Then you're going to start having universal basic income that we need to have to support people. I don't think we're there at all yet, but I think it's going to be very, very transformative to, or very disruptive to what we see today.
So if I can ask this question, and Frank, you may be able to answer it. We had that dip down because of these fears about these other companies, or they, you mentioned Salesforce or somebody has, and it dropped last week. So why the big surge back up on Friday?
Well, because the realization this isn't going to happen in 5 minutes. I mean, these things are going to take 5, 10, 15, 20 years. By the time it's moving along the way the internet is now, which will maybe be a decade or more from now, we'll be talking about quantum computing and how it's going to disrupt everything. The facts are progress continues, and this is not a bad thing. And all these things will be transformative, just like the printing press was a few hundred years ago. And these things aren't going to end. There were other things that impacted this market last week as well. All these companies have borrowed a lot of money. Japan raised their interest rates. This mysterious thing called the carry trade, where people borrow their money in a country that charges little or no interest and then invest it in a country that has high interest rates like the United States, and they make that spread. When that spread narrows, that becomes less attractive and money starts moving around. And when it moves around, markets move. Now, they sold bonds, bought stocks on Friday, maybe. All these things are in play. It's a very complex animal out there. And to try to look at one thing, even though the AI thing is huge, it's not the only thing out there.
All right, well, that leads me to this question then. That is AI going to rule the market? In other words, will we see all sectors subject to these swings since businesses are now jumping on board with AI?
I think it's going to be a very interesting dynamic to watch because we have been experiencing some sector rotation into other areas of the market that will indirectly benefit, whether that's utilities, whether it's industrials, materials, because in order to support AI, you have to have infrastructure to do it. So we do see some rotation. And at the end of the day, I think that, to Frank's point about how long is it going to take, what we're dealing with right now are extremely high valuations within that particular segment of the market. And what we experienced last week really goes to show you how fragile that market is. When you are trading at such high valuations, you know, it's like falling off the roof rather than falling off the porch. So we want to make sure that we're paying attention to kind of the return on invested capital, which I think everyone's trying to figure out as these companies are borrowing money to fuel their AI development. Are we going to reap the rewards of that in a time frame that investors will be satisfied with?
Funny you mention that. Right here on my list of questions for you guys, I have, how soon do investors want to see a return for one of these companies, which some of them are investing billions of dollars into this? So how soon do you want to see a return?
It's sometimes $100 billion and $200 billion. I mean, a billion's like a nickel now. You know, it's nothing. All right, so it's a huge amounts of money, and this is where the volatility is coming from. Investors are beginning to question that, ask that very question: when are we going to get a return? And are these companies that are making these bets, if you will, are they going to survive the time it takes before they actually start generating profits out of it?
Kim,
And there will be casualties. I don't know who they'll be. Maybe Kim does.
thank you, General Eisenhower.
I sit here in this seat before you because I worked in AI companies in the late 1990s who did not return, not shareholder value, well, they didn't return shareholder value either, but they really didn't provide value to their customers. And so I'm extremely wary of a very long timeline with kind of a hand wave of here's where productivity comes and here's what it's going to, do without actual numbers. And this is an issue for me. The other thing is the fundamental technique that they're using that causes the hallucinations or errors, that has not been fixed. And I scan the internet and all kind of computer science areas looking for the people who are working on that fix or correction or whatever. So there's a lot of uncertainty on when and how we're going to do this. I just saw last night OpenAI is now running ads in some fashion. So what we're really saying is maybe it's a search engine and it gets search engine pricing. That's a mismatch with how much money it costs to make these models. It's not going to be, the money-making machine that Google was, because it's really hard to match up, ads to people who are asking specific questions. And you must trust that the answers are right, not just what an advertiser wants you to think, right? So there's a lot of questions that are still out there about the profitability of the large language model.
It's interesting you bring up about whichever one was advertising.
OpenAI.
I think if you watch the Super Bowl, there were at least 3 different AI companies that put up ads on that. So
No. They're not having ads. They are placing ads to the user. They're selling ads to place to users, just like Google does.
Okay. Well, I'm just telling you also they had ads on television there. So it's interesting you bring up that you don't want to wait 100 years to find out whether anything's going to be profitable. Carrie's laughing because I think she knows where I'm going with this. And that is Alphabet is now selling a 100-year bond in the United Kingdom. I guess you have to make sure that either you're going to be around or your family member is going to be around, and that the company has to be around for 100 years for that bond to work. Good idea to buy one?
What's the interest rate? I didn't see it.
I don't know. I didn't get that.
That's the big question, I would say. I mean, there was a time when who was the country that did this during COVID when rates went to zero? They sold a 50-year bond, which was a great cash raise by them. And again, this is probably, depending on what the rate is, this is a great investment for Google to lock in. If it, assuming it's a fixed interest rate bond, which I imagine it is, and all that, this is a great investment by them. I would never as an investor want to take on something of a duration that long at all.
It will have value as interest rates move around because it will be extremely volatile. As interest rates rise, that will go down a lot, and it will be an interesting thing to purchase when the next time interest rates go down or go up, and it goes down a lot. All right, because prices are inverse to interest rates, and if next time interest rates go up a lot, I would probably look at it as a trading vehicle, but not as an investment, because after they go up, they'll at one time or other, sooner or later, come back down, and that thing will go up in value. And it might be more volatile than other bonds. Then again, because it's so long, it might be ignored.
Yeah, it's a good point.
Well, I think the interesting thing is just it's issued. They're issuing them in sterling, and is it Swiss francs too?
I think I saw that. Yeah.
Yeah,
So
I think
it's
you're
not
right.
even dollar denominated, and I believe it was oversubscribed.
Hmm.
So someone out there is buying them.
Well,
And
you got-
if you look at it in terms of diversification, considering that these are in different currencies, maybe that's an added appeal given the debt levels of our country.
Well, I would guess that insurance companies or pension funds would be interested in this kind of vehicle.
Yeah, because they have perpetuity type
Right.
time horizons.
Yeah. Well, let's move off of that, but I have to ask this question, and that is, so we had those 3 days of downward movement. Did that entice you guys to take a look to buy this dip?
Well, full disclosure, one time I've been right lately. I personally bought the dip on this, and I think that's kind of what you're seeing a bit still in the economy today. There's still have faith in the economy. The economy still, I keep talking about this, and I know I sound like a broken record. We're still pretty bullish on the economy overall. Housing's starting to look a little bit better. Manufacturing numbers are really, really good. The only sort of hiccup that we would continue to pay attention to is jobs, right? People are not leaving their jobs to go look for. Anytime you leave your job, that's kind of when your job numbers look good, because everybody kind of leaves a job to go look for another one or get another job, and then as an employer, you got to hire somebody else to fill the jobs. And people aren't leaving their jobs really that much right now. And outside of a few headline news stories with Amazon, UPS, Dow, et cetera, slashing jobs a little bit, most employers are still kind of holding on to the employees they have. But otherwise, economic numbers look pretty good. So I think investors are still in that mode of, okay, the market sells off 4 or 5%. This is a pretty good opportunity to quote unquote buy the dip. And to Carrie's point earlier on, regarding the broadening out, you're seeing this, and this is a great thing for the markets, I think. You're seeing a lot more breadth in the markets, right? Only 3 sectors are negative on the year so far. The other 8 are positive by a large margin. Energy's up 20% this year. Materials up 14%. Industrial's up 14% or so. And so you're starting to see a really broadening out. It's not just those 7, magnificent 7 stocks, or not just the AIs that's driving the market. So you're having a lot more breadth in the market, which is, I think, an overall positive, certainly for 2026.
All right. Well, AI, I want to follow up on this because AI, of course, has captured all of the headlines, but there are other stocks, as you point out. And Kim, we're nearing the end of the fourth quarter reporting period here. What have we got, about maybe 2 more weeks or so of reporting to go? So where do we stand, and have there been any major surprises to the good side or the bad side?
Well, there always are. We're taping this on Tuesday, February 10th. Coca-Cola had some not disappointing news, but a little bit of a slip there. And they're saying it has to do with their bottlers. It's more complicated than just they're the company that sells Coke. They have kind of an opaque distribution channel, we'll just call it. And, sometimes accounting catches up. That feels like what's happening, but it's also, people aren't necessarily buying a whole lot of their product. The volume is up 1%. I think this really speaks to the consumer. The consumer is somewhat lagging, and that's what we're seeing in today's wrap up of the earnings. Is a lot of the more business to business kind of companies are finding good footing, but again, the consumer still seems a little skittish, we'll put it that way. And I think companies are setting realistic expectations for the rest of the year, which in analyst speak, that means they're sandbagging a little bit. They're a little on the soft side, but still we're going to have another year of upward movement in earnings and revenue as companies are, that's their guidance.
This begs the
So
question. Go ahead.
it's an interesting year because this is now the third year that we've had this. And usually we take a break every other year or so, and that's not what's happening.
So if you're saying consumers are reticent right now, and the fourth quarter would include the holiday period, if I'm not mistaken, does that not then, maybe goes hand in hand with your last comment, does that bode not well for the future of the next couple of quarters if consumers were reticent during the holiday season?
Maybe, but I don't think it's that big super correction either. I think we have rolling corrections throughout different industries. And because we all work in a different industry, well, not the people here, we all work in financial services, but you know what I mean? The broader economy, people work in a lot of different areas. As Michael pointed out, real estate and home building has been kind of missing for maybe 2 years now. And if that comes back, that could give an impetus for forward growth. Because business to business companies are not really pulling back, or the worst thing would be is forecasting lower sales this year than last year. You know, we're pretty confident that at least the public market economy and the companies that are in there are seeing growth. So there has to be growth somewhere, and you're right. Consumers are the big chunk of growth, and whether or not they had a sour mood when they're going shopping at Christmas, you know, is that going to slop into 2026? It's unknowable.
Well, I will say we had a retail sales number out this morning that was 0.
Right.
So, you know, this kind of fits right along with the narrative of a slowing consumer. And as we know, our economy is made up 70% of the consumer. So if we see the consumer slow, it really is a major headwind. You know, all the talk that we have about AI and business to business and everything else, if that consumer isn't healthy, that's when you might see valuations start to come down. So I know that we're going to hit a little bit on the jobs number because that also supports this, I don't know, maybe developing narrative about what's going on with the consumer. You had asked the question earlier if last week was a buying opportunity. And right now we want to see more data about the health of the consumer. One of the other reasons that we see as kind of a, I don't want to say red flag, but maybe a yellow flag, is that we have seen bond yields drop. And when we see that happen, it's kind of a sign of, you know, what do people really think? If the bond market is saying that, you know, if we're seeing interest rates go down, that is conducive to the perspective of maybe a slowing economy off of the kind of the peak that we've been out more recent.
I know somebody who paid off a mortgage at 2 3/8% rather than invest the money because his long-term projection of what the market's going to do isn't worth the risk. And he saves 2 3/8% to pay off his mortgage, which is nothing. And you know, as an older person, so that figures into the equation as well. But I personally think that the consumer, they're not changing jobs because they aren't experiencing growth. We've got this K economy that's basically the sales are being driven by the wealthy, business owners and the like, and the top 20 or 30%, depends on who you read as to what that number is. And but it's still more than half the people are struggling getting through the month. These are not good things. And you know, we have an employment problem. People aren't moving, people aren't hiring, but the workforce is not growing either. All right. So there's a lot of conflicting things that, from my experience, are rather new. So that means you probably have to go back 100 or 200 years before you see this type of thing before. And I'm sure it's happened. I just don't know when.
Michael, you want to wrap this particular segment up for us?
Yeah, I don't. I mean, I'm not. I agree with Frank and Carrie. There are a ton of, caution flags out there. There's always a ton of caution flags out there, and I'm not sitting here. I'm not necessarily a bull on the economy, even though I sound like one. Although I kind of am. I think to Frank's point in the K-shape, yeah, we have a K-shape recovery, but I feel like it's always a K-shape scenario where, unfortunately, we live in an economy where a lot of people, no matter what the type of economy is in, kind of struggle to make ends meet. And a lot of times they're paycheck to paycheck. And that's just the way, our capitalist society has been for centuries. But all in, the labor growth, I also think that could be a problem, but also we don't know what AI could potentially do to circumvent that problem. That's do we need as much labor as we used to need? And that's all sort of unknowns at this point.
It's a new,
All right, so
it's a
go
new
ahead.
world.
Yep. Basic question for you guys then is: do you view the labor market right now, the employment picture, as a glass half full or half empty?
Ugh.
Well, I guess we'll find out tomorrow. We get some numbers, some really important numbers tomorrow. I also still believe that, we're still trying to really get a grasp on it based on the government shutdown that we had last year. So, I think we're starting to get some real numbers. There's been some very mixed numbers in terms of, the 4-week average of initial jobless claims continues to rise. We haven't necessarily seen a bump up in continuing claims, but we do know that there are more people looking for jobs than jobs available, which is a dynamic that has reversed more recently. So I think that, the numbers that we get are going to be very helpful into sorting this out to really get a better gauge on the consumer.
I'm pretty hopeful that the housing market picks up, and we're starting to see data inflections of that happening. And if that does kind of pick up, that should be pretty good for the job market. Certainly, each new house, creates, I can't remember the number, 5 to 7 new workers or something like that. And so I think that'll be a good data point to be mindful of as well.
When somebody moves, they spend money. Just period. I mean, it just goes without saying. You have to buy a piece of furniture that you need in a new place. You have furniture you don't need anymore that you have to get rid of. So all this, that's a lot of activity. Drapes or blinds or whatever that is in style this week.
Not even when you move, Frank. I mean, Kim bought her 4th house the other day, and you got to furnish all that kind of stuff. I mean, you have that many vacation homes. You got to continue to maintain upkeep. It's a lot. I mean, Kim, you can speak to that. Go ahead.
Now, I would buy a horse. If I wanted to just burn money, it wouldn't be my 4th house. I have 1.5. I have a chicken coop.
All right, final question for you. We've got to wrap this thing up, and that is, and I know, Michael, I know you believe in Santa Claus, but not the Santa Claus rally. So, if I've got that correct, there's another adage that if the Dow Jones Industrial Average and the Dow Jones Transport Average both go up, then it will be a continuation of the bull market, and that's what we've
That's
seen.
the Dow theory, and it's clearly in a bull phase.
All right.
I do believe in Santa Claus. Thank you. And I do not believe in the Santa Claus rally. So you got that right. Stacy, I can't even tell you the last time I thought about, looked at, or cared about the Dow. So that's Kim loves that. So Kim can definitely opine on Dow theory and the 30 stocks that are in there.
You don't know it
That
hit
is
an
not
all-time high last week? You
That's
don't
not my
know it
version.
hit. You do not know that the Dow hit an all-time high last week?
I did. I saw the news headlines. I didn't read anything about it, though. Of course, I don't open that. I know I know it did that. Yes, but I don't care about the Dow really that much.
I'm part of that club, totally. I was, honestly, I was having a conversation with myself this morning as I got ready going, how can I express my hate for the Dow without sounding like a market elitist? And I can't. It's an ever-changing number that means nothing, but whatever.
It's funny having this conversation when we're looking at different indexes and really trying to get a gauge. The S&P 500 obviously is the most popular, but what we really try to look at even more so is what we call an equal weight S&P 500, where you're smoothing the fact that the S&P 500 is a market cap index, which means that the largest companies are going to be the biggest drivers behind performance. When you actually look at an equal weight index, assuming they all contribute the same, it gives you a much better view of how corporate America is actually doing.
And what would that index be?
The S&P equal weight.
S&P equal weight. I'll take a look at that. Also, thank you guys for joining us once again. Good conversation today. We'll continue our look at investing in the economy in our future editions. And since you're watching or listening to this podcast, I ask that you hit the like or the subscribe button. That does it for now. But thanks again for joining us for The Bull, the Bear, and You.